Good afternoon. My name is Daniel DeCruz, and I work alongside your wholesaler, Howard Amdahl, who is based out of Winnipeg. Thank you for joining us today for our precious metals update featuring Maria Smirnova from Sprott Asset Management, who is on the line in Toronto. Sprott is a sub-advisor to all of Ninepoint's precious metal strategies, including gold, silver, and silver equities, and they have been the leading precious metals expert since 2000. In a time of increasing uncertainty about global markets and geopolitics, there is a focus on precious metals and real assets, which offer low correlation to other assets and can serve as a natural hedge. All of your lines are muted, and you can follow along with the presentation and ask questions online. We will be sending out the presentation and notes from the Q&A after the webinar. I will now turn it over to Maria.
Thanks, Dan. And thank you for having me here. I think it's a very timely thing to talk about right now, as both gold and silver seem to be breaking out of their longer term downtrends and going up and carrying the precious metals equities with them. So with that, let's talk about, here's the agenda. So what I thought we'd do today is I broke the presentation into three main parts. The first one, and to me is a very critical part, is the macro environment and the macro update. The second part will focus on gold and silver bullion themselves. And then the third part will go to the equities, and we'll talk about the Ninepoint Gold and Precious Minerals Fund and the Ninepoint Silver Equities class. So I will skip these slides. These are the Ninepoint Partners firm overview slides, and we'll jump straight to the macroeconomic outlook. So let's start with a recap of what's happened in the last few years. The last several years have been truly difficult for precious metals investors. The general markets, such as the S&P 500, have been roaring to new highs almost every day over the last 7-8 years. And at the same time, gold and silver have been dubbed relics of the past. Gold saw a low of 1050 at the end of 2015 as the Fed was preparing to start raising interest rates. And since then, gold has actually attempted to break the 1350 level several times, but has really traded within the $1,200 to $1,350 range. Now that both the US and European central banks are preparing to ease, gold has broken out of its range after the June FOMC meeting. And then silver underperformed gold until very recently, until July 16th, when it finally broke its downtrend and sent the gold to silver ratio lower and sparked a rally in silver equities. Year to date, gold bullion is up 11% and silver bullion has gained about 6%. These rallies have been precipitated again by central bank U-turns. So the Fed is widely expected to cut rates next Wednesday at the next meeting by at least 25 basis points, and the European Central Bank today adopted a formal and aggressive easing bias. So it sent a maximum dovish signals regarding its plan to deliver a broad easing package starting in September. In fact, the Governing Council said it's determined to act using all instruments. However, this easing isn't happening fast enough, according to some political leaders. For example, President Trump is known to criticize both the Fed and the ECB. And in the gold square, I would say that within the last 6 to 9 months, what we're seeing is a beginning of a consolidation phase. And we've had two very big deals announced, Barrick merging with Randgold and Newmont combining with Goldcorp. Now, a third deal we saw was an Australian company buying a Canadian company. But really, we feel that these two big deals of Barrick and Newmont are the early innings of a bigger consolidation play in the mining space. So we will see what happens. Let's now talk more about the macro outlook. So the next slide, I have the US real GDP growth for the last several decades versus the US Fed funds effective rate. And the reason we focus on the US, by the way, so much is we do feel that it has a lot of influence worldwide. Obviously, it's a large economy, but also it sets the tone for gold, and gold is denominated in US dollars as well. So what we can see in this chart is that real GDP growth has been lower in recent years than in prior decades, and that is the blue line. And in fact, the monetary easing that the Fed has started after the financial crisis was designed to stimulate the economy, and it did, but not with the results that some people have hoped for. And another thing we can see on this chart is the gray line. The interest rates have been, it's unprecedented how low they have been over the last several decades. They've never before been at zero levels. So in the past, central banks have been able to fight economic slowdowns by lowering interest rates to stimulate lending, which in turn would encourage investment. But what happened in the last cycle is that companies borrowed money at low rates, but used the proceeds for share buybacks, dividend payments, instead of investing the money for CapEx and growing their businesses. So that's starting to backfire. So what we're seeing now are signs of slowing economic activity, and we're expecting GDP growth to start turning lower once again. Going to the next slide, this is another look at interest rates, but this time versus budget deficits. So again, this chart's pretty long term, going back to 95. And the blue line is the budget balance. And you can see as the line goes down, that actually means an increasing deficit because these are negative numbers. So in the past, the Fed has usually reduced interest rates when they saw increasing budget deficits. So the last cycle of the last 3 years was the first time where we saw budget deficits increases together with increasing interest rates, which is of course means this is not sustainable. And in fact, we're already seeing, obviously, again, signs of the Fed making their U-turn and starting to reduce interest rates. And again, the economy is showing signs of weakness, so this will precipitate declines in interest rates. This is all, of course, positive for gold. Now, another theme in the background of all of this is the demographics. You can see this line shows the combined Medicare, Medicaid, Social Security payments or obligations as a percentage of private industry wages and salaries. And since 1966, that line has been decidedly growing until present. So while the Trump administration this week struck a deal to raise the budget cap for 2 years and suspend the debt limit through July 2021, really, it doesn't solve the overriding issue of growing debt. Inevitably, the demographics will make it so that some combination of significant tax and spending adjustments will be needed, or alternatively, continued money printing. So one of the more negative secular trends has been the declining worker to retiree ratio. This decline began just before the financial crisis and will continue for the next decade before leveling out at low historical levels. This year, this ratio is expected to be at about 4 times, and it is poised to drop all the way to 3 times in the next 10 years. So this development will continue to strain government budgets. If we just look at the cost of entitlements today, it would require more than 30% of private wages and salaries to fund the entitlements. This doesn't even include costs to fund government employee compensation. So if we included this, it would require 60% of private wages to fund these obligations. These are the effective tax rates required to fund these massive outlays today and are only going to climb ever higher due to the aging population. So the question is how to finance these obligations. Short of having big increases in tax rates and or cutting entitlements, the government can just print more money. So monetary debasement will continue. Again, this we feel is very positive for gold. The last slide on interest rates. This is a global slide now, and it shows the relationship between global debt with negative yields versus the gold price. Right now, globally, there's about 13 trillion in negative yielding debt. This is the highest since 2016. And basically what it means is investors would rather hold gold, which is a safe haven asset, and there's no coupon, than bonds with negative returns. All right, so finally to our outlook. I've spoken a bit about the macro outlook and the weakness in the economy, but there are three main factors we feel that are driving gold and silver higher, and all are, intensifying. We feel they're intensifying. So the first one, again, is the global macro outlook. That is softening. We look at the PMIs, the global manufacturing indices, and 64% of the world has PMIs that are negative or less than 50. And this includes the Eurozone, China, Japan, Korea, Malaysia, Taiwan, Mexico, and Canada. In the US, PMIs are also declining and approaching 50, and we think they might go lower. So the second factor is trade tensions. And of course, we hear a lot about this in the press. At the G20 summit in Japan, we read about a supposed truce between China and the US, but there's been no real resolution. And it seems like the talks are not progressing well. And there's also growing trade tensions with Europe. The Office of the U.S. Trade Representative said on July 1st that it is considering tariffs on an additional 89 items against the European Union. This would bring the trade value of items under consideration for tariffs to $21 billion a year. And finally, geopolitics. We've read a lot about Iran lately. On July 7th, it was reported that Iran would breach the 2015 nuclear agreement for the second time by enriching uranium above the agreed upon 3.67%. Breaking the nuclear agreement is an attempt to put pressure on Europe, China, and Russia to do more to offset US economic sanctions. To this, President Trump said, "Iran better be careful." And Secretary of State Mike Pompeo threatened further steps against Iran. And finally, we have one last slide on the macro outlook, and there's a lot going on here, so I apologize, but I'll try to explain what I'm trying to say here. So I've talked a lot about interest rates and how the economic outlook is affecting how the Fed and the ECB are viewing interest rates and their policies. So next week, Wednesday, we have an FOMC meeting, and we're expecting basically a 25 basis points cut. Right now, we're coming out of the longest expansion in history. This is the third slowdown in this expansion cycle from 2008, but this is the first slowdown after a Fed tightening cycle. So the Fed has raised rates about 9 times since the end of 2015. And in fact, the Fed funds rate is at a 10-year high. So the rise in rates has an 18-month lag on growth. So we just finished tightening at the end of last year. So we have another year or so for the effects to take place. So what this chart is trying to say is that in the past, when we've had Fed tightening cycles, the slowdown has been a harder landing than when slowdowns happened without Fed tightening. So this time around, because we are coming out of a Fed tightening cycle, we're expecting the weakness to be bigger. So we think the slowdown will likely be deeper than prior ones. So this is what we're expecting going forward. Continued declines in manufacturing PMIs, declining earnings growth, and Fed rate cuts and slowdown in GDP growth. All of this is positive for gold as a portfolio diversifier and a real asset. So let's turn our attention now to gold and silver. Here we have a chart going back to 1988, I believe. Yellow line being gold and a gray line being silver. Gold peaked at 1900 in 2011, and silver peaked at about 48, 44. So we're still far, far away from these levels. Gold would have to increase 35% just to get back to that level, to that high. And we truly believe that it can go higher than that. And we believe also that silver would have to triple to get back to 48. And of course, we think that silver could outperform gold and likely will, as it has done in the past bull markets in gold and silver. So what we're seeing in terms of investor demand for gold and silver, one aspect we can look at is ETFs. Blue line is silver and gray line is gold. And we're seeing a definite pickup in both inflows into gold and into silver ETFs. So particularly into silver, we've seen at least 50 million ounces come in. This is the largest monthly inflow on record so far this month. And what we're also seeing is a pickup in silver US mint coin sales, and they're up 43% year to date to June. And another thing we're seeing is a pickup in trading volumes on the Shanghai exchange. So we think that China has been a great player in both gold and silver, but they will be even a bigger player going forward. All right, turning to silver more specifically, you know, up to very recently, people would say to me, oh, silver is dead, nobody cares. And that is because the gold to silver ratio went to 90 to 1 or 93 to 1 even. But in the past, you can see it has definitely fluctuated within a range. So as of right now, I think we're sitting at about 86 or 87 to 1, if I'm not mistaken, or 89, sorry. So we think that silver has the potential to outperform gold significantly. In the wake of the global financial crisis, the gold to silver ratio went to 80 to 1 and bottomed at 32 to 1. And the silver price topped at 50, again, like I said, $48, $50 an ounce. So we're already down from 93 to 89, and we think that there's significant potential for it to decline further. The annual silver market is actually very small at $15 billion of value a year. So it doesn't take very much to move the price. So we're already seeing that investor demand come back. And if that continues and grows, obviously there's a lot of upside. So I also wanted to quickly mention silver's fundamentals for the physical market. Just looking at, in the last 10 years or so, it's been a balance to actually silver has been in deficit. But what's important going forward is that we think that the mine supply will continue to be constrained. There's been a definite lack of discoveries, both in gold and silver. There's been a lack of new mines in silver as well. Scrap has been low. There's been no government sales. And on the demand side, again, we're expecting a pickup in the investment demand, which would cause the metal to be in deficit and would contribute to a rise in the price. So turning now to the equities, let's look at the gold equity valuations. The top panel shows forward price to cash flow metrics for a group of larger gold producers. And while we're off the bottoms in the last couple of months, we're definitely not at the top of the range, and we're closer to the bottom of the range. So we do see that these equities are not expensive. On average, they're trading about 9-10 times cash flow, and they have significant upside in them, given past history. Similarly, if we look at the long-term gold equity to gold bullion ratio, that's at a very, very bottom. And similarly for silver equities as well. This is a chart again of consensus forward price to cash flow for silver producers. It is off the bottom as we've had quite a run in the last month, but it's still not near 20 times cash flow that we've seen in the past. So again, at least a double from here, if not more. And remember, these metrics compiled based on consensus analyst estimates for prices. And generally, analysts have a hard time keeping up with the spot price, and they don't model things on spot. They model things on their forward pricing. So right now, I've looked at the consensus, and both in gold and silver, analyst forecasts are below forward prices in gold and silver, which tells me that these multiples aren't even accurate, really, and they should be lower than they're shown in the chart. So to sum up our gold and silver outlook, the macro environment dictates investor interest in both gold and silver. We are seeing signs that retail and institutional demand are returning, interest is returning. And that is because, again, we see global economies weakening, we see continued global debt levels rising, we're seeing record levels of negative yielding debt. Trade wars are contributing to this picture, and fiat currency debasement will continue going forward. So while I don't make predictions as to gold and silver prices, I thought it would be interesting to put down this quote from an analyst at Cornerstone Macro. And that is, I have no real price objective for gold and silver other than higher, which is to say the bet is that we're witnessing a structural change taking place for the first time in years in which precious metals are outperforming general equities. Wouldn't that be something, right? So I hope that explained our views on the macro level. So why don't we take a look at the gold and precious metals fund and the silver equities class. Briefly, on our team at Sprott Asset Management, there's 3 PMs responsible for running the gold and precious metals fund. And that is myself, Jason Mayer, and Shri Kargutkar. We're all 3 of us are a little bit young, but we all have significant experience in the sector. I have been at Sprott for over 14 years now. I also manage the silver equities class. You know, I've worked with Eric Sprott, John Embry, Charles Oliver, and have learned from all of these guys. I meet with hundreds of companies a year. We definitely scour, you know, the 3 of us can cover a lot of ground in terms of looking at various companies. We go global. I'll talk about it later, but we've made significant investments in Australia, for example. So we have quite a bit of reach, the 3 of us. But we're not alone. We have 3 technical advisors that help us out on a day-to-day and weekly basis. All 3 of them happen to be economic geologists. Andy has a lot of experience in the geology world. Neil also has both investment and geologic experience, and Justin is also a geologist. So these 3 guys are fabulous. They're very, very experienced, and they're very, very helpful. So we can always turn to them and ask them to look at things for us. So our core philosophy has always been really that gold and silver are historical stores of value. They are alternative asset classes which are good for diversifying a portfolio, and they protect portfolio in times of economic turmoil. So again, just to reiterate, we have global reach and global focus. We don't focus just on North and South America. And then in terms of portfolio construction, we sift through a lot of ideas all the way from early stage exploration to production, you know, from first drill results to, like I said, building a mine. And we do various evaluations, it being technical, and again, we rely on our 3 guys for that, financial, et cetera, et cetera. So we kind of narrow the universe down to a funnel, and we focus on 30 to 40 stocks. And we overlay that actually with country risk and other risk factors to make sure that our portfolio is balanced. All right, so looking at the Ninepoint Gold and Precious Minerals Fund, here we have some performance figures. I would say that since, you know, month to date, the fund is up another 11% already. it has been a good month for us because our focus has really been on smaller cap companies. Now, the top 10 that I'm showing, they're all production companies, but if you go beyond the top 10, you'll see that we have about 10% in pure earlier stage exploration companies. We have about 20% of the portfolio focused in silver companies, and about 20% of the portfolio is focused in Australia. That's kind of, those are some of the buckets that we look at when we categorize things. We also focus on free cash flow yields. So when we do our portfolio diagnostics in the producing sector, we see that at $1,400, our portfolio yields about 10% in free cash flow. And then at $1,500 gold, if we run our portfolio at that, it goes to 15% free cash flow. So there's a fair amount of leverage in the portfolio to rising gold prices. So, Howard asked me, well, talk about the opportunity. I think that the opportunity here is really great. This sector is really under-owned by generalists. And when generalists go into the sector, which they kind of started doing a little bit, but not to a great extent, these names can double and triple very easily because the sector, again, is just not very big. So that's the gold fund. We also have the Ninepoint Silver Equities class. Again, that fund is up another, I believe, 13 or 14% in the month. And I apologize, can't show that number here. But that is strictly focused on silver equities. And again, what I've been trying to do in the last couple of months is add earlier stage exploration companies, earlier stage companies to the portfolio. So kind of going downstream, looking for leverage to a rising silver price because we have such a strong belief in the silver price. And I guess that's it. I guess that's the fund codes. So I guess, Dan, we will take some questions.
Thank you, Maria. As I mentioned, we'll be sending out the presentation and notes, and we'll follow up with each of you in the meantime. If we've had any questions, we'll put something together and send it out as well. But in the meantime, do not hesitate to reach out to Howard or myself. Thank you for joining us, and have a great week.